Hello, everyone. This is Volts for April 29th, 2026. Enabling ordinary people to invest in renewable energy projects. I'm your host, David Roberts. Investing in energy infrastructure has generally required a lot of money, which has made it the province of wealthy individuals and large institutions. But that is starting to change, at least a little bit. A handful of companies have been using a corner of U.S. securities law called Regulation A to let ordinary people invest directly in solar projects. Not stocks in solar companies, but the actual projects themselves, with minimums as low as $100. One of the more interesting versions of this is a company called Energea, which has a specific twist. Rather than focusing on domestic projects, it goes where institutional capital tends not to. Rural areas in Brazil, South Africa, and as of a few weeks ago, Colombia, on the theory that the best solar returns are in markets where capital is scarce, but sun is plentiful. As a bonus, the projects extend access to reliable electricity to some of the people in the world who need it most. Since launching in 2020, Energea has grown to hundreds of millions of dollars in assets across nearly 200 projects in 6 countries. Mike Silvestrini is its co-founder and managing partner. Today, we're going to talk about how this model works, whether it delivers what it promises, and whether it can ever matter at scale. With no further ado, Mike Silvestrini, welcome to Volts. Thank you so much for coming.
Hey, Dave. Thanks for having me. Appreciate it.
Yeah. So earlier in this century, you were in sort of the conventional renewable energy biz. You'd say you were a renewable energy developer working on big scale projects with big scale investors doing the normal thing. And then in 2020, you pivoted to this, which is allowing basically what they call retail investors, small investors to get involved. What was your experience there in the 2010s that led you to this? What was the dream here?
So I think that in a lot of ways, Energea has been in the works my whole life. So it really brings together my love of travel, my fearlessness to go into other countries and explore them and talk to people and meet people and see what makes them tick, but also my profession, which is renewable energy. And in 2017, I had sold that first company. It was called Green Skies. My partners and I exited. And for the first time in a long time, I didn't have any solar panels or engineers or capabilities or accountants. My whole company was gone with the swipe of the pen. But I did have some capital. And what we decided to do as a family is to travel. So, of course, packed up our bags, and my wife, and at the time, 2 kids, now 3, we hit the road and we were traveling. And of course, I couldn't help myself but to stop and meet with solar energy companies in the countries that we visited, in Asia and Africa and Europe, South America. And I kept on hearing the same story, that there was these perfectly capable solar developers, sophisticated guys who had real projects and could not really find access to capital. And having just, coming fresh off an exit, I kept thinking to myself, well, geez, I would buy this. I'd rather own this project with Unilever in Singapore than some stock. Now, maybe that was, in retrospect, not the greatest vision, because the stock market has done pretty damn well since then. But at the time, it's just an asset class that I know how to underwrite it. I know if it's likely going to make any electricity or not. And I know if the customer is likely going to pay us or not. And it just seems like it's the comfortable place for me to park my own capital. At the same time, my lifelong buddy, Chris Sattler, had just sold his energy company as well. And we were actually at a board meeting in Kenya for some wildlife conservation work that we did during that time period, still do. And he was kind of in the same situation. So we said, why don't we invest together? And Energea was really born as an opportunity for Chris and I to invest in the asset class that we know best in lieu of other investment options, having come off these exits. That quickly kind of grew into like a friends and family type of opportunity. because we discovered what was going on in Brazil, and it was just a white hot solar energy market. And because we're used to this industry, it didn't take us long to accumulate a couple hundred megawatts worth of inventory to invest in. And we had outkicked our own capabilities and called in some friends and family, mostly people who were sort of part of our first enterprises and who had done well by us in the past, the low-hanging fruit, if you will. And we really enjoyed it. I really liked communicating with them about the projects that we were investing in. And I would go and visit the projects and make like little videos and show them like, hey, here I am. This is the project. This is its location. Here's the town nearby in Brazil, trying to show them that like it's not as wild as it sounds to park some capital in this place. While that was going on and I was falling in love with servicing individual investors, we did bite the forbidden fruit once again and pursued some institutional capital, because that's what you do, right? When you have a couple hundred megawatts of inventory, you dial for dollars and you call some of the big boys and you bring home some capital to make these projects real. And we did that, and we did a couple of deals, actually. We did a deal with Brookfield. We did a deal with a listed trust called Victory Hill on the UK Stock Exchange. We did a deal with BTG Pactual, which is a big private equity company based in Brazil. So, the usual suspects for that particular market. And it didn't take long for me to realize that I really preferred serving my friends and family and the individual clients that we had directly than I did working with the large institutions. Not only did I like it more, but it was getting better results. These institutional dollars come with all sorts of restrictions and strings attached. And especially in emerging markets, you got to be quick on your feet. And they're just not quick on their feet, Dave. And like it took us only a couple of years of sort of seeing these two forms of capital directly in competition with one another to realize that the direct to consumer investments were outperforming the institutional investments. And we liked it better.
And it was outperforming. I mean, we'll get into this later, but outperforming because of the lack of restrictions. Like I'm trying to figure out why one pool of money is going to do better than another pool of money. It's just you're able to use it more freely.
Yeah, exactly. If a decision needed to be made, I need to fire a guy, I need to hire a guy, I need to buy a different module, I need to whatever it is, I just do it.
Right.
And that's what you need to do to move in these types of emerging markets, especially. But really, it's also the same in the US. Like there's that flexibility to be the manager, what we would now call a general partner. But in the days, we just looked at it as we're solar guys. We know what we got to do here. And we know more than the sources of capital that we were using. Because, I go to Brazil. Chris moved to Brazil. He stood up our Rio-based office. We have a 35-person at the time Brazilian team. We knew Brazil and we knew these projects. And the capital over in the UK didn't. And that made the difference in the performance of the portfolios that we managed without restrictions and the portfolios that we managed with restrictions.
Interesting.
And it came down to dollars and cents, but it's also a quality of life thing. Like I said, I mean, I love communicating how cool these projects are and how they work and just completely transparent. Like the goal is absolute transparency, not like in a Ray Dalio kind of way, but like in explaining to an investor what the heck it is that they just bought.
Right. Well, that answer raised a million questions for me, but before we get into maybe some of the kind of political and economic questions, let's just start with the basic model, which is one of these retail investors. So you opened it up from friends and family to basically any now small investor.
Well, not at first. First, we did a Regulation D offering for friends and family because the friends and family that we selected were all investors. They had the means to be qualified. And when you do that, you do a Regulation D. This is the way a group of guys would get together and buy a piece of real estate, or really any private investment ever has generally been done under Regulation D. And that worked. But I had a bunch of friends that I'd known for many years who I wanted to bring along on this ride. And maybe they couldn't, stroke a check for $100,000, but they wanted to come in for like $1,000. And I think of some of my friends back from high school and stuff who I wanted to work for them in this asset class that I know well. I knew it was a good investment for them. How do I let those guys in? Well, there's one form of Reg D that allows you to have up to 35 non-accredited investors. So we went with that one first, but that just wasn't going to cut it, because there were so many more people that had interest. So then we kind of discovered Regulation A. And now we do in parallel Regulation A offerings and Regulation D offerings, so that there's a place for sophisticated investors and family offices and registered investment advisors. They can come in through the door they're most used to seeing, which is a Regulation D offering, with a private placement memorandum, which is a fancy word for a business plan. And then I take that same exact document, I cross off private placement memorandum and call it an offering circular. And now it's the same exact device, but in the Regulation A context. So we run those in parallel. So really anybody can come and invest through Energea.com.
If I invest with you through Regulation D versus I invest with you through Regulation A, am I, the customer, getting anything different? Are you using my money differently? Is there anything, in other words, but a sort of bureaucratic distinction here?
Well, the distinction is how did I find you? Because there's a cost to that. So when I sell, the securities are for the same underlying portfolio of assets. Like when you buy through a Reg D offering or a Reg A offering, you buy our Brazil product, for example, you're buying participation in a portfolio of projects in Brazil exactly the same way, same cash flows, same everything, same reporting. But the difference is that if you're a Regulation D investor and I found you because you went to your registered investment advisor and your registered investment advisor told you about us, the registered investment advisor has to get paid a fee, and that fee will change the overall economics of the purchase of stock from Energea. Whereas if you came in from Regulation A, I had to run like a Google ad or some sort of ad spend in order to find you. So they have different costs to discover them. There is also a Regulation D share class that we offer of like, you're rich, you're qualified, and you found us. There's no reason to pay anybody. So you get a feeless access to the product. So it really just depends on how our clients discover us and matching them to the appropriate fee paying category.
Okay, so if I'm one of these little guys then, coming in through the retail investment, coming in through the Reg A side, I buy whatever, $1,000. I give you $1,000 and I tell you I want to invest it in the Brazil portfolio. What exactly am I getting and where is the return coming from?
Okay, so you're buying a share of a company in Delaware called Energea, let's see here, Portfolio 2 Brazil LP. That's the name of the company. And now you have a share of that company. So the company issued you a share in exchange for the cash. Now the company has your cash. And thousands of other people have done the same thing. So there's cash sitting in the bank account, and it's owned by thousands of individuals proportionally, depending on how big the check size you decided to invest. And then Energea takes that cash and we go and invest it in a solar power plant. When we first started in Brazil, there wasn't really operational inventory that we wanted to buy, so we constructed a lot of it ourselves. But now as the market has matured, more often than not, we're buying operating assets.
Oh, interesting.
So we're just stepping right into that cash flow. And then as those projects sell electricity, we collect the money, we pay for the project's operating expenses like your insurance and your landscaping, module cleaning, and all those types of things. And then the money goes back up to that Delaware company that you own. And then the Delaware company has some expenses. It has mostly regulatory fees and legal fees that it pays for existing. And then it pays Energea a management fee that we charge for our services. And then whatever's left after all the fees have been paid gets distributed to the shareholders pro rata. And we just basically drain the account every month.
So that account makes it sound like the sole source of income for investors is the selling of electricity from the solar power plant.
That's right.
Is that that's the source of the returns?
That's it. The sale of electricity and rental fees from batteries, and in some portfolios we have issued debt on projects, so the collection of principal and interest payments on debt. But it's always, even those debt payments are ultimately paid for by the sale of electricity too. So it's all about the assets, the underlying steel in the ground that sells electricity under long-term contracts, and then getting that back up to my clients.
That's interesting. So then the revenue that's going back to clients then it seems to me, is tied to economic fluctuations in the price of power, fluctuations in power markets. In other words, tied to electricity markets and whatever volatility they may contain. Is that right?
It depends. All of our projects have long-term contracts. So before we buy an asset, it's already pre-sold its energy for an agreed upon rate for an extended period of time, usually 20 years.
I see.
So we kind of know, like, if we make the power, we already know it's sold, and we already know it's sold at X price. And that price, more often than not, it escalates, at least with consumer price index. So it's escalating every year, which helps us keep up with inflation. So those revenues rise as inflation occurs. But there are some contracts, like in Brazil, for example, a lot of our community solar assets will sell energy instead at a discount off of the then applicable energy rate. So you wind up saying, the energy rate this year is 10 cents. I'm giving you a 20% discount. I'm going to charge you 8 cents. Next year, it's 12 cents. And so I apply the same discount, and so on and so forth. And the reason why we like that is because we're trying to give our customers the lowest risk action at the highest yield. And to get the risk mitigated, you want to diversify it. And we want some of our contracts to escalate with CPI automatically. We want some of our other contracts to escalate with the fluctuations in energy prices. It's like hedging. You take a little bit of both flavors. And in some years, energy out-inflates CPI, almost always. In some years, CPI out-inflates energy, depends on the year. But either way, we're going to have some winners in there. We're going to have some losers in there, but it'll net out to have a nice, consistent dividend yield.
What about appreciation of the assets themselves? Does that bring in money?
They depreciate. When you have a solar project, it's most valuable on its first day when it still has 20 years remaining on that initial contract. It's as valuable as the future cash flow anticipated from that contract. That's the NAV, or net asset value. So the value of the project is basically all that future cash flow brought back to today's dollars. As time marches on, that contract is getting shorter and shorter. Now you've gotten cash already. You pulled cash out. That's great. But the value of the asset is shrinking. And it shrinks until the last month of that contract period, at which time it's essentially worth zero.
I mean, maybe this is a complete tangent, and maybe you haven't been invested in any of these things long enough to know, but I'm sort of curious. Like, the new solar field in Brazil signs a 20-year PPA, sells power for 20 years. Then what? What happens to old solar fields? Like, are there 30 and 40-year-old solar fields somewhere, and what are they doing? And is anybody paying anything for them?
I just bought a 17-year-old solar power plant from Macquarie in California, and we took the panels off. We recycled about half, and half of them were pretty good. We sent them to Africa to be reused and for schools, powering schools.
Oh, interesting.
And then we took the site. It's at an airport, the Fresno Yosemite Airport. And then we took the site and we repowered it with new equipment. Now, solar's changed a lot since it was installed in 2007.
Better panels,
different voltage, new inverters. So a lot of the gear had to be swapped out. But there was still actually some years left on the original PPA. So we went ahead and are taking advantage of that PPA with a new set of gear. The reality is that the interconnection point, these capillaries along the grid, there are only so many places to insert solar energy.
Yeah, that's the valuable thing for that solar field. I mean, that's
right.
Its asset.
I think so. I think that there will always be a solar plant at many of these locations, at least for like a real, 50 years.
Yeah.
So that's our position, but I don't know that for certain, and I don't want to promise things to my clients that I don't know. So we just call it zero. But I hope one day to have some great news for my clients when we figure out how to realize that second life of the asset value.
Yeah.
And I think that'll happen. And a lot of investors are bolder than us, and they will go ahead and call it a 40-year asset and say, well, it's not these panels and it's not this contract per se, but we'll make some assumptions about that, and then we're just going to call it this super long tenured asset. I'm uncomfortable with that. So we don't assume like exits. We don't assume repowerings. We just kind of look at it for what it is in the ground and give it a valuation based off that method.
But yeah, like you say, it is the land and the interconnection, right? That
Yeah.
somebody paid a lot for. And the panels are relatively cheap. So like, why wouldn't you just keep throwing new panels at that spot?
Well, plus they last a long time. And those panels came off of Fresno Airport. I sent them over to Mbirikani, Kenya, installed them on a school, and they're outperforming P50 over there, just cranking away.
So this brings up then, there are other companies doing this, I think, taking advantage of regulation.
Nah, not really.
well, maybe we can talk later about the comparison. But why overseas? Why emerging markets?
To get my clients the highest return on investment, a lot of these solar plants, you've seen some lousy financial products come out of the solar energy industry before. A lot of these yield cos were really crap. They had really low returns that didn't do much for anybody. They were exposed to market manipulation and buy sell pricing. And I don't think there's too many investors out there who can say that they're really ecstatic about their yield co position. So we wanted to create a product that was better than that. And it started off by thinking, like, what would a perfect solar portfolio be, if we look backwards? It would have some of that New Jersey stuff from the 2010 timeframe. It would have some Japan feed-in tariffs. Remember, Ontario had a killer feed-in tariff, couple of those in there. It'd be easy to imagine this rock star portfolio looking backwards. And that's pretty easy, being a Monday morning quarterback. But how do you do that looking forwards? And that's what we try to do at Energea. It's like, where are we going to make the most money? I think we're going to make the most money in Brazil, riding the clock back 5 years ago. And I think we hit that square on the head.
Well, what are the qualities of a place that tells you that you can make a lot of money there? Is there some kind of formula?
Absolutely. And we publish the rationale behind our market selection to all of our clients. And then we publish the rationale behind each project selection to all of our clients. But, a market analysis takes about 3 years. So it's a long process of getting to know a country. I'll go there 20, 30 times. I'll meet with the accountants and the tax folks and the lawyers that I need in order to even think about a market. I'll start to get to know, what types of assets and policies exist, where the opportunities are, whether or not there's any good developers out there that I can really bank on.
I'm really curious how much of that process that you're discussing right there is talking to business types and financial types versus interacting with the political class.
Zero political class. Zero.
Really?
It's zero. Yeah.
I want to ask about that later too, because I have questions about the politics in these places. But so the idea is, for instance, now you're starting in Colombia. The idea in Colombia is there's big demand for solar, a lot of solar going up, but it's still hard to fund solar projects. That's kind of your sweet spot. Rising demand, difficulty structuring capital.
It's actually worse than that for Colombians currently, because not only is there a rise in demand as they, want more electrical devices and more technology in their economy, but they have an extremely hydrocentric energy grid. And there's El Nino factors and El Nino factors. So these are big cycles, and they're not very friendly to businesses that want to run 24/7. Being attached to a grid that's primarily fed from hydroelectricity.
It's funny. People think of hydro as stable. People think of hydro as sort of like the iconically stable baseload source.
Yeah.
But it's really true that
it's not stable at all.
Quite variable with weather. I don't know if people appreciate that.
It's completely variable. I mean, your price can go up 800% overnight.
Yeesh.
Yeah. So, they need solar, and solar is quick to deploy and it's cheap. It's just, solar is a super technology as far as energy infrastructure goes. And, I may have gotten in this industry, at a time when it was very environmentally driven. And that's kind of how I made my career. But the reality is that as you get older and you kind of understand the way the world works a little bit more, I'm here now because this is the finest asset class for energy infrastructure. And we need tons more energy all over the world. It does not emit carbon dioxide the way some other fuels types do. But even if it did, it would still be the best technology in energy on a cost and deployability basis.
Amen. Hallelujah. The reason, and I'm sure this is the question on a lot of listeners' minds, which is the reason institutional capital is hesitant to go in these places is that there are risks. There's the risk of political instability. There's currency risk. So, for instance, Brazil, is paying you in the real, but the real has been volatile. And then, there's just there's regulatory risk. Basically, there are unique risks to these kinds of markets. And I'm just curious about your sort of attitude toward risk management, how you think about those risks.
In the way you phrased that question, it made it seem like those are considerations when working overseas.
Well, the minute I said political instability, I was like, right.
Well, these are risks that every market can be measured by and needs to be measured by. And political risk affects every single solar project, no matter where it is, including the United States, as we know. So does currency risk affects every single project in every single market, no matter where you go. So it's not a question of are we entering the fray and exposing ourselves to these new risks? It's about measuring those risks and diversifying exposure to those risks so that we have the highest probability of making our money as projected for our clients. And the reality is where I've dealt with the most political instability has been the United States. The project that gets robbed the most is in the United States.
God.
So there's a lot of security related issues that we have here. The dollar has weakened against foreign currencies. So really the country that we work in that has the most geopolitical, foreign exchange, and security related risks thus far at Energy in the last 5 years has been the United States. And I'm not saying it's going to be like that forever. That's why we have a position in the United States, because ultimately we believe the United States is the gold standard for low financial volatility, low political volatility, and security. But that has not been the case. So that's diversify, right? And in this asset class, I think that we're bringing to our clients the best concoction of solar energy investment strategies.
I wanted to just dwell on the politics for one more second. You say you don't go talk to the politician. I'm just curious how you think about, for instance, Colombia, in this new venture in Colombia, you are working with a government agency that has been created specifically to spread solar and battery systems to, small households. You got a big policy and public money tailwind. What happens if something happens in Colombia, elects a very different kind of government? How do you think about political risk? I know this is sort of embarrassing to ask from the U.S. right now for reasons you just laid out, but how do you think about in those countries? How do you think about political risk?
First of all, you have to understand that the United States had built our solar energy industry in the most complex and unnecessary way of any country. We had tariffs. We have tariffs on one side and tax credits on the other.
It's hilarious. It
doesn't make any sense. And then we have every single state has its own strategy, and it's a nightmare. But other countries aren't like that. So in Brazil, there's no government intervention. The only time I call upon the government is if the utility company isn't upholding its end of its obligations, and I need to compel them to through a regulator. Other than that, it's without government intervention. I buy the solar panels, I import them, I install them, I sell the energy to my customers, I collect the money, I send the money back up to the U.S. There's no government involved. I don't need a tax credit. I don't pay any tariffs. It's just...
Are they subsidizing it all? Are they doing anything to...
No, there's it's not needed.
In Brazil, it's just purely happening based on money.
It's actually every market except for the United States, where you unadulterate the energy markets. Solar energy is extremely competitive.
Interesting.
I feel like I could go to any country in the world and figure out how to pencil a solar energy deal. And without any government subsidies. We only believe we need government subsidies because we have electricians that make $500 an hour, and we have these types of issues that are the cost basis for our projects are so blown out. And the reason why they're so blown out is because the presence of artificial capital. So you're starting off on the basis that solar energy is actually cheaper to install without any government. So that's why I have such a light touch point with government agencies when I do most of my business. But you brought up the Latin America portfolio, where in this portfolio, one of our investments is a loan to a company called Helios.
Right, which is different. Just to underline this, in Brazil, you're investing in projects.
Right.
In Colombia, you're loaning money to a
utility
agency,
company,
which is doing the projects.
Yeah, they're a utility company. And this utility company has become particularly good at providing solar energy to folks that are disconnected from the grid. So we call this rural electrification. And in Colombia, the entire architecture of their grid rate structure is geared towards enabling Helios to do what Helios does. So it's not like a policy, it is the architecture of it. And what I mean by that is they take the entire society and they divide them into 6 baskets by zip code, essentially. There's the wealthiest down to the poorest, right? So the folks that Helios are serving are in the lowest basket. And the people in the wealthiest baskets, this is like sort of beachfront property in Cartagena, they pay the highest energy price. And it goes all the way down through like the 4 wealthiest layers. And then the 2 poorest groups don't really pay it much or anything at all for energy.
That's interesting. So their electricity rates are progressively structured.
Yes, exactly.
What a thought. What a novel and interesting thought.
Yeah, I mean, I can't make commentary as to whether or not it works on a societal level, but that's the way they do it. And so the money from these, wealthier groups goes into a fund. And so the only time I met with the Colombian government was to go meet with the administrator of that fund and confirm that the money was cash sitting there. And that it was truly and exclusively used for its stated purpose, which is constitutional. So it's beyond law. It's the strongest format of law.
Oh, interesting.
And I wanted to verify that this wasn't all smoke and mirrors. I mean, I see the money coming into Helios's bank account. I'm checking their bank statements. I know that they're telling me how the law works. That's all well and good. But I want to go shake hands with the guy and make sure that it works the way everybody says it works. And it turns out it does. So we felt really comfortable loaning money to Helios so that they could expand more energy services to these rural communities and have confidence that as they perform their service, which I think they're the best in class at doing this, they should be doing this around the world. They're amazing.
Service meaning literally going to these little places, installing a solar and battery,
yes,
a functional solar and battery system.
And then keeping it on. There's so many of these projects and, these, free projects that just don't work. It's a crisis amongst do-gooders throughout the world, especially in places like Africa. I see it all the time.
Do they do maintenance?
Yes.
They do like follow-up maintenance? Yeah, that's so important.
Yes, they monitor them. They use radio networks to keep the cost of monitoring down so they can see the performance of every asset. It's really, really smart guys. And it works. I would love to see this whole thing copied and pasted in certain African countries and other South American countries.
So Helios has around 20,000 subscribers.
Yeah, you've done your homework, Dave. Nice.
Which is, it's depending on which angle you look at that from, it's either big or small. So I'm wondering, like, what
to put into perspective, there's about 280,000 households remaining with no access to electricity whatsoever.
Jeez.
And we believe that the loan architecture that we put in place with Helios, back to back with the capital origination architecture we have at Energea, we can aggregate capital from American investors, serve that up as debt to Helios, and knock out the remaining homes that need electricity in that country.
No kidding. 280,000 more. Like, presumably one constraint is like
about $100 million.
Yeah. Capital's one constraint, but presumably there's like workforce and.
Yeah, but these guys, that's what they do, right? They have hundreds of offices, these little offices, so you have like a community leader, and that leader helps communicate directly to the homeowners. And when the homeowners have an issue with their system, they can go to that community leader. So there's somebody they can speak with.
What a cool model.
And so they have this whole thing set up. It's awesome. And it really works. And then you have all these like unanticipated things happen. So when people start getting electricity who never had electricity before, like, what are they going to do with this electricity?
Hey there, everybody. Don't worry, I'm not going to tell you about a new mattress or push a credit card on you. This isn't an ad. There are no ads on Volts. It is supported entirely by listeners like you. If you'll indulge me for a second, I'd like to ask for your support. I started Volts because we're all surrounded by depressing news about climate change and misinformation about clean energy. And it's never been more important to share the stories of the real people on the ground doing the real work of transition and all the ingenuity and courage and public spirit they are bringing to it. People are hungry to hear these stories, to learn from and find inspiration in them. I've heard from people who changed majors or careers after hearing episodes of Volts. people using it in classrooms and community groups, even state legislators who have passed bills inspired by specific episodes. Sharing these stories matters. It makes a difference. If you have found value in it and want to help me continue doing it, I hope you will join the community of paid subscribers at volts.wtf. It's about the cost of a cup of coffee a month. If you don't like subscriptions, you can make a one-time contribution, leave a review on Apple or Spotify, or just tell a friend about Volts. I am grateful for any and all support. If you're already a paid subscriber, thank you. And now, back to the show.
And then you have all these like unanticipated things happen. So when people start getting electricity who never had electricity before, like what are they going to do with this electricity?
I'm so fascinated by that question. Yeah, what are they doing? I'm so interested in what happens.
There's a lot of really cool stories out of this, and we tell them at Energea as best we can. But one of my favorites is that they make these bags called mochila, which is like a bag that you kind of hang across your chest and put stuff in it. Boys and girls both wear these types of mochila bags. And it's a craft made by the Wayu communities, which is the people of La Guajira, which is where one of the groups of 20,000 installations that have been done is. And they took the inside of a dryer, like a clothes dryer, which has a spinning capability, and they powered it with this new solar array that they had. And then they used that to become a thread spinner so they could make more yarn. So they're using a dryer, repurposing a dryer with this new solar array to dramatically increase their production of mochila bags. God. So who knows what they're going to do with it?
I'm such a sucker for those stories. I could listen to that. I should listen to that crap all day. Like giving electricity to people who have not had it. I mean, I know we talk about that a lot, but I still don't think we talk about it enough. Like I am so excited to see what are 280,000 people going to do when they have power, like
pump water.
Imagine all the creativity you're bringing on board, basically, that you're like enabling. You're just enabling creativity and innovation. But so I want to talk a little bit about Regulation A, about the sort of structure of this thing. So Regulation A does come with some restrictions. It's sort of a lighter weight version. Like you don't have to do a full IPO, but you do, when you're doing Regulation A, have certain disclosure and reporting requirements, really tight disclosure and reporting requirements. I'm just curious if those requirements, if the requirements bounding what you can do with Reg A, if you experience those as a constraint at all. It also has, I should say, and then I'll throw it to you, it also has a $75 million a year cap for what you can do under Regulation A. And I'm just curious whether Regulation A is giving you the freedom of movement you want, or if you're looking around for other things, other ways around it.
First, with regards to disclosures, we think that what's required of us to disclose is nowhere near enough. We want to disclose everything. We want to just show people exactly what it is. There's no obligation for us to go down and make a video of the Wayu people and show the installations and then demonstrate through a mini documentary how this thing really works. But that's what we want to do. We want the people to actually understand this. There are some financial requirements that we have to report on. We would do that anyways. So from a regulated communications standpoint, it falls short of Energea's goals. So it's not an impediment at all. The $75 million a year is also not an impediment because, number one, it's $75 million a year per Reg A, and we have 4 Reg A's right now, so that multiplies it a little bit. And then we've only raised, we're just rounding the corner on $500 million, so we're at like 470 million. So, and that's over several years. And this is every 12 months you can raise that 75 million. So we have a lot of growth that we can handle before we would start bumping up to that. But we really opened up that parallel Reg D so that the larger check writers are coming in through a different channel that does not bump up against that Regulation A limit. So for all those reasons, we think that we can scale this puppy as big as we can get it.
I mean, you can imagine a scenario down the road where you have maxed out you know what I mean? You've maxed out, I guess, the capability of retail investment. I mean, that would be a good problem to have.
I mean, I haven't dropped my Italian portfolio in there yet. It's another 75 million. And then I have my Southeast Asia portfolio. It's another 75 million. And then, you kind of stack different products out of this. And then you pipe your biggest checks through the Regulation D offering. And I think that this can work at a multi-billion-dollar scale without a problem.
As you said earlier, the solar business sort of in its early days was filled with do-gooders, mostly top to bottom. And that ratio has been, steadily changing over time as it grows and scales. I'm guessing the institutional investors coming in through Reg D are probably mostly pretty unromantic yield chasers. I'm curious about the retail side. Are you getting a bunch of do-gooders, or are those just people wanting to make money too? Or what is the do-gooder ratio? I mean, maybe you don't know for sure, but
so basically, when somebody decides that they want to be a client of Energea's, they come to Energea.com, and we only ask them for the minimum amount of information that we need in order to satisfy our regulatory obligations. There's some know your customer type stuff that we need to ask, with the exception of one question. From the very first day, we set up on the onboarding process a meter that ranges from all the way left, you have, I'm here to save the world, and all the way to the right is, I'm here to make money. And we ask our clients to sort of set that best describes, what brought them to Energea. And it's been interesting, but it's been very consistent. And it's about 60% pegged towards making money. So slightly leaning towards, I'm here for the yield. And it makes sense. This is money that people may be saving for their whole lives. This could be grandma's retirement. This could be your kids' college money. This money has a purpose for you and your family, and it is sacred stuff. And we treat it, we operate this all the way pinned to the right. We have an exclusively capitalistic, do not lose money, it's a sin type of approach to running this business. But we do want to know what our clients, how they feel about our product. And while some clients will come in and, say like, look, this is disposable income, and I'm going to go ahead and do this because I think it's cool to power these rural communities and community solar in Brazil and African businesses and stuff. And they'll go ahead and move that needle to the left, but it averages leaning towards the financial returns.
I'll just ask flatly, do you, in the operation of Energea, ever encounter a tension between the sort of make money side and the save the world side?
No.
Are there tensions, or do you think you have a lot of runway where you're just getting sort of both?
There's so many beautiful, it just turns out that impactful projects are also projects that are commonly overlooked by institutional capital, and that's where we make our money. So it just naturally aligns itself with impact because that's where our capital is most useful.
The places you're building these, maybe it varies on your different portfolios, but are you, like in Colombia or in Brazil, when you build a solar field, are you introducing a community to electricity, or are you bolstering an electricity system, typically?
So it ranges. All the way to one side, you have the story we just told about rural electrification in Colombia, where it's brand new energy infrastructure for people who have never had power. All the way to the right, you have utility scale projects, like we're developing a project in Texas to sell all the power to a big tech company to power an AI data center. And then in between, you have things like South Africa, where they have access to a grid. Most of our customers, all of our customers, have access to a grid, but the grid is unreliable. Mm-hmm. So we're providing them what we call microgrids. So they have solar plus batteries to depend on for a consistent flow of energy. And when the solar and batteries are unavailable, then they pull energy in from Eskom. So it's a little bit of a tweener, but the full range is fair game for us.
The fact sheet you sent me, the risk disclosures, and I think this is boilerplate, but it says suitable only for investors who can afford the loss of their entire investment. I'm guessing that's boilerplate, but I'm just curious, are there...
I think it's every investment, right?
Is there anyone who shouldn't do this?
No.
You know what I mean? Is there anyone you would warn away from it?
I don't know what my regulatory restrictions on are answering this, but I'm just going to answer you how I feel, which is that I search far and wide for places to park my personal capital. And I keep on ditching alternatives and going back to an asset class that I know best. So for Mike Silvestrini, I can wrap my head around steel in the ground that produces power that's sold under contract to an underwritten client on a long-term basis to make a dividend yield. That makes sense to me. And I've been doing this now for 20 years. I've never made a dollar doing anything other than this. This is my expertise. So for me, this is a wonderful asset class. I think that there are years where the stock market will beat the crap out of solar energy yields. We've averaged in a little bit, 12.03% return on investment since the day we opened our doors. Not a bad investment return for energy infrastructure. In fact, I think we're top quartile at the very least across anything you can invest in an energy infrastructure. But, we have underperformed versus the S&P 500 during that same time period. We've overperformed versus real estate during that same time period. So we're one of the best asset classes in the private markets. And I would say that we're competitive and complementary to public market investments.
Have you ever invested in a project and lost it, or lost money, or lost the project? Or have you had a big disaster, or have you had a money loser, a lemon?
I've had two in my career, but neither of them were complete losses. One of them was in Connecticut, where I'm from here. This is my first company. We did a project for a marijuana growing company. And this was kind of a new law. It seemed like a cool idea. Seemed like these guys had a lot of capital to swash around.
I remember that hype cycle.
Yeah. And then they we finished the project and then sent an invoice and they never paid it. Guys, I don't know if you're high over there, but you got to pay this bill. Eventually they did, but it was after I had sold the company. And then there's one project at Energea that did not affect our clients at all because I knew it was exceptionally high risk. So I wrote the check myself and it was only $20,000. I put 20 grand into a project in Zimbabwe, which you don't have to be a rocket scientist to not invest in Zimbabwe. But I was working with a company. We had bought maybe 15 or 20 great assets from this company called Sun Exchange, and they wanted to do it. So I said, well, that's too risky for my clients, but let me give it a go. And I pooled up with some other investors and bought into a project. And after the installation of this solar plus battery project for a farm somewhere in Zimbabwe, the police came and said that basically they're pretty sure it belongs to them, and they just took the array.
Jeez. As I was saying about the risks earlier, that's kind of what I was referring to.
Yeah, Zimbabwe is a risk, but South Africa, where all of our Africa-related portfolio has been concentrated thus far. I just came back there. I was there for the last 2 months. What a spectacular country that is. I mean, it has issues, but so do we. And I think it's a fantastic place to do business. And there's some really intelligent people doing some great things there.
Can you just briefly review? You have 4 portfolios.
Yes.
Just briefly tell us where they are and what rate of return you've gotten on them, because that's different from portfolio to portfolio.
Yes, that's true. So basically, our first portfolio we launched was Brazil. And that has been squarely around a 14% return since the day we opened our doors in dollars.
That's real good.
That's after our fees in dollars. Yeah, it's a good return. Because when we first got there, everything looked like a 22, and then you kind of deal with the realities of Brazil. And Brazil's a really hard place to do business. Yes. I think the hardest, in my opinion, the hardest place in the world to do business has got to be Brazil. But even after taking our lumps, we managed to hit our target, which was a 14, and we've been right on that the entire time. So we're really proud of that. It takes a lot of work and a lot of grit to accomplish that. Our second product that same year in 2020 was the Solarize Africa portfolio. Our goal has been a 10. We're at a 9.8. We're fighting like hell to get that extra couple basis points up there. And we will. I know exactly where it's going to come from. And that market is just so exciting. And it's actually become the easiest market for me to manage because there's so much investable inventory there. There's good debt markets. You can buy and leverage projects.
Wait, investable inventory meaning solar fields already built? I would think that would be sort of the iconic, there's nothing there market.
Well, what happened was there's a bit of a contraction of the South African industry. And when that happens, a lot of stuff goes up for sale. So
I
what
see.
happened was the South African grid only worked for like 60% of the day for years.
Yeah.
It's called load shedding. You get an email in the morning and say like, you're not going to have power from 6 p.m. till midnight. Like, great, thanks. They solved that mysteriously right around the time of the last election. It just went away like a fart in the wind. Everybody had power 24/7. So when that happened, a lot of solar companies were really banking on that to sell their products.
Oh, right.
And they hadn't really taken the time to get more cost efficient because they didn't need to. Everybody wanted solar and batteries at any price. And the bad companies all tanked when load shedding went away. And that threw up a bunch of inventory onto the marketplace, which we've acquired some of that. And then there's also now the energy markets are really improving very rapidly in South Africa. They were so scarred by this load shedding stuff. They almost had a political blowout about this. I mean, it damn near killed the country, this load shedding. And they're paranoid about energy availability now, rightfully so. And finally, they're starting to do stuff about it. This huge onslaught of new renewable energy is going to make sure that never happens again. But also, they're putting in place some policies that they should have had a long time ago that allow us to do what we want to do, which is I want to buy huge chunks of land, put big chunks of solar on it, and then sell that power to whoever I want. As long as I'm willing to pay for the transmission and delivery of that, who cares? Well, now we're at a place where you got to string together a couple licenses, and then you can do that. And that's what we're building a lot of right now. So it's insatiable. I love the African market, and it's 400 basis points lower than Brazil, but it's less risky. Like South Africa is a less risky country than Brazil, period, end of story.
That's interesting. Why are the returns lower? Is it just the price of electricity is lower?
It's less risky. It's appropriately priced. I thought it was off. I went over there and kind of, was hooting and hollering saying, this isn't priced right. This market is riskier than you guys think it is. The rand is riskier than you guys think it is. Stop treating these deals like I'm in Manhattan.
Right.
And I was proven wrong over a number of years. And having this great vantage point of working in the US and Africa and Colombia and Brazil, I get to really compare them in my mind as to what the real risk is of these places. And South Africa is a wonderful country. And it has poverty, extreme poverty in a lot of places. They need to deal with a lot of their demons. But it also has a robust public markets, robust business class, great wine regions and luxury restaurants and scalable companies and telecoms. And they are sort of the Manhattan of the African continent. So it's a cool place to do business. And it's not as risky as I had initially anticipated.
So that's Brazil averaging around 14%.
Yep.
South Africa averaging around 10%.
Yeah, 9.8. LATAM, which we just launched, after 3 grueling years of research, due diligence, we finally picked some investments that I feel really great about. One of them being that Helios Investments, and we have some others coming that we'll disclose, once we put pen to paper.
And these are in what countries?
We're starting off in Colombia because Colombia is the hot hand right now. Colombia is where Brazil was 4 years ago. It's just like such an obvious thing that this country needs tons more solar. So we're excited to be there. There are a couple competitors, but it's kind of a small market, believe it or not. Even though it's like the 3rd largest economy in Latin America, it is still a fairly small market and overlooked by large players. Because who wants to learn everything there is to learn about Colombia only so you could do a couple hundred megawatts? Well, we do.
All right, that's 3. Is there a 4th?
The U.S.
Right.
Yep, which is a 7.1% return realized over the last, I think, about 4.5 years. But its dividend yield last year was like a 9 for a good chunk of the year. So its actual cash distributions have exceeded its IRR at certain points because the portfolio is very stabilized. All of our off-takers in that portfolio are either municipalities or utility companies. So it's a good investment grade product. We get paid on time. Almost all the time. EverSource in the Northeast doesn't pay on time, but everybody else does. And you can count on that portfolio to deliver. It's why it's a little bit lower yield.
Are you expanding that portfolio? Like, are you pursuing projects in the U.S. as aggressively as you are in these other?
Yeah, I'm in the process of buying 15 megawatts up in Maine's community solar program, which took a shot in the jaw change of policy risk. But we're buying it after that change in policy, so we're really comfortable with where that's landed. And we're also developing that project in West Texas I mentioned with the tech giant offtaker.
And in none of these cases, in all four of these portfolios, in none of these cases do you lose sleep about political winds shifting and yanking the rug out from under you.
I mean, I'm appropriately paranoid about every characteristic of every project in every portfolio, and I drive that into my team. So, we have to be on our toes. We have to be ahead of the curve, and we have to make our money fast. And it's just because things do change. And that's why a lot of our clients come in, they see the 14 in Brazil and they just pump all the money into Brazil. Brazil raises $2, out of every $5 that we raise. It is a big number, but you know what? Brazil's Brazil and you should diversify. And we made it really easy. We made this thing called the core, which you can just, say, I want to put $100 in, and then you can just move some toggles, be like how much LATAM versus how much solar Africa versus USA. And, but I really do believe that we built this intentionally to be a cocktail. The ice in the drink is the US and these other countries are the flavorful booze, and you mix it all together and you have the best thing.
Towards the end of time here, but I'm just curious about the scale. I mean, I think probably like the reason big institutional investors don't do this is, I'm guessing, just these soft costs of like, if an investor comes to you with several $1 million, it's one set of conversations and then you've got $1 million. You now are raising $1 million from whatever, 50, 100 people, 200 people. How do you keep those transaction costs kind of in line? You know what I mean? Like, there's a reason big investors are not doing this.
What transaction costs?
Well, I guess, I don't know. I'm asking you, like, are there more transaction costs?
No, it's actually, we've gotten rid of most of the costs. That's why this product overperforms, is because there's not as much BS between you and the asset. The only BS you have is paying us, but we're providing a service. We originate the deal, we manage the deal, we do everything for the deal. So that's a service worth paying for. And all those returns I stated are after our fees. So, we pay for ourselves by finding the right investment opportunities, I believe. And we have investors that range from $100 to $63 million. So anybody can come in and participate on the platform. Our hope is that over the next few years, you start to see more family offices and professional investors engaging Energea. I've managed solar energy projects for the likes of Goldman Sachs and US Bank and Rabobank, and you name a big bank, I've probably done business with them in my career. And now we're taking that same level of professional integrity and making it into a product fit for any investor. So I hope that we're giving people who don't normally have access to the types of investment strategies that I've been doing for the last 20 years. Now they can come directly to the source and participate at energea.com. And people are.
And it's
$100 minimum.
Yep. Which, there are, I meant to ask this earlier, there are other companies out there raising small amounts from retail investors and investing them. So, but you said no one's doing what you're doing. So I'm curious about this.
Not even close.
I'm curious about this landscape. What are those other people doing, and how is what you're doing different?
I won't, name names or talk down to my competition. I think there's enough room in this world for multiple successful retail energy infrastructure companies. I just don't see anybody that even comes close to the services that we're providing. I think it's because we didn't come up with this idea, in a college dorm room thinking to ourselves that, hey, we could build a website and everybody can invest in solar. We came at this as solar professionals and experts first, developers, having serviced customers like Amazon and Target and Walmart for my career. And then, learning in the crucible of sophisticated financial institutions kicking my ass to get me to do things correctly. I did that first. And then we decided to open up our services to the broader retail market. And I see a lot of companies in this who aren't truly solar energy experts. They have a good idea. It's such a good idea that we did the same thing, but it's just a different approach. And I think that we're head and shoulders above anybody else out there.
This is kind of a dumb question, but like, just to make clear, like Joe Schmo, who's listening right now, can go to Energea, choose a portfolio, put their credit card number in, bada bing, bada boom. You don't need lawyers or
nope.
You don't need any institutional anything.
You should read, watch the videos. We've given you like sort of different levels of due diligence. We hope that everybody reads the offering circular. And of course, that's the main document that describes what we're going to do with your money. And it also describes how our fees are charged. It describes, all the risk factors that we can think of exhaustively, so you know what you're getting into. But they come in, they drop $100 in, we take that $100, we're going to park that in a solar energy asset amongst other solar energy assets in a portfolio. That's another thing. You're not buying one project, which would be a concentration risk. You're getting access to a thematic approach to a niche solar energy market somewhere in the world. And you can even diversify that across all portfolios, put $25 into each one. You really spread that dollars around and minimize your exposure to catastrophe. I think we've made it really easy to invest on Energea.com. We've got a great CTO named Gray, who just does a phenomenal job with the user experience. You can also, with a couple clicks, I don't think there's anything on the internet that you can open up a retirement plan and invest tax efficiently the way you can at Energea.com through our IRA product.
It's really cool because I get this question all the time, Mike. I'm sure I'm telling you nothing, but like, God, I've got tons of people who contact me either like, I can't get solar on my house, or I already have solar on my house. Done what I can in my personal life. I still want to do more good in the world. I still want to invest in this. I'm not a millionaire, like.
We made this for that guy.
So let's talk about, as a final question, scale. As you say, you're not solely retail. You've got a mix of investors. You've got some big ones, some small ones. I'm just curious about the retail side of it. Let's say you're up to 500 million. That's not what retail investors have given you. I think that's more like 120 million or something. That's all the money you're managing. You're up to like 500 million, which is like, if I'm a poor farmer in Colombia, looks plenty big and exciting. You know what I mean? But like from a global perspective, is pretty tiny, is a rounding error. What is the scale possible for retail investing? Do you think this could be more than sort of a niche pocket of the investment landscape?
Well, the answer is, who knows? But here's what the data looks like. How much money does the average guy walking around have in America? This is just, talking about the American general public. Well, the savings accounts of Americans, so just savings accounts, is about $18 trillion. Private investments, like, when you pick up and make an investment through an app on your phone, that's $67 trillion. And the workers of America have $45 trillion of retirement accounts, which we can accept. So that's $130 trillion being wielded by guys like you and me and your neighbor and the people who we live amongst here in our country. So a very small fraction of that being won over by consistently delivering on financial promises, backed by real assets, adjusted for inflation, diversified. If people can find room for renewable energy infrastructure in their investment purview, then I think that the sky is the limit for Energea.
I'm sure you would be happy with just one of those trillions.
And that's right. Just $1 trillion. That's all. We'll see where this goes, but I actually do think that we play a role in the long-term architecture of the energy grid, because most investors buy these projects with the intention to eventually sell them, or they're being bought with a time limit fund. So they have to eventually trade. And we don't. Our plan is to hold them forever to create the dividend yield, which can be reinvested each month, creating a compounded return for our clients, which 90% of our clients do. And that is what we're here for. So we're the last stop of many projects' long journey. So we think we can, continue to gobble up stuff and consolidate some of these markets and be a useful drop-down option for people looking to move on and exit a project position.
Absolutely fascinating, Mike. This is all just Energea.com. If people want to go read more, look at videos. Thank you for sitting with us today, walking us through this super fascinating little corner of things that I had not really looked into. And it's booming like everything else in solar. So thanks for coming on.
Dave, real pleasure. I remember meeting you over at Yale one day, maybe a couple years ago. I don't know if you remember that.
Yeah, no. We talked about doing this someday,
Yeah.
and I'm still going to take you up on your offer to come, hang out in Brazil and
You should.
look at some solar panels up close.
I'm heading down there in a couple weeks. Invitation's open.
Thank you for listening to Volts. It takes a village to make this podcast work. Shout out especially to my super producer, Kyle McDonald, who makes me and my guests sound smart every week. And it is all supported entirely by listeners like you. So if you value conversations like this, please consider joining our community of paid subscribers at volts.wtf, or leaving a nice review, or telling a friend about Volts, or all three. Thanks so much, and I'll see you next time.